All right, my name is Rob Phelan. I'm also known as the FI Educator Online. I'm joined today by Sonia. Now, tell me your last name. How do I say it?
Castelan.
Castelan. From Castelan Tax Services, and she's going to be talking today about all things taxes. Make sure you check out the student reflection document that comes with this presentation. You should be able to print it out or sign it digitally. It should look like this. And the first question on is, what is a question that you have about taxes? So before Sonia and I can get started today, please try and answer that. Like, what do you want to know more about? And if we don't answer it for you during the presentation, consider asking that. So what's your profession? What do you do? Give us that little bit of backstory about you.
Oh, yes, for sure. So I'm actually a first-generation Latinx tax professional here based in Connecticut. For those who are not familiar with that state, that's in the East Coast area, right next door to New York. I actually have over 8 years of corporate experience with a focus on data analytics. And I was actually able to transfer over that skill that I have, given that I had been working with large data in the past, to basically be where I am now as a Latinx tax professional. I actually serve the BIPOC community, gain financial confidence, and also help them minimize their taxes by incorporating tax strategies so that they're able to keep more money in their pockets and also look to expand their financial portfolio for a better future.
Okay, so helping people to do their taxes, like this is what a lot of us are looking for help with. So this is perfect. And I love that you have that special niche group that you really help. That's awesome. If we want to think about taxes and income tax, the first place we have to start is like, well, why do we pay taxes? Do you want to handle that one, or do you want me to take it?
Oh, I can handle that one.
Let's do it. Why do we pay taxes? What's the whole point of this thing?
So basically, taxes in a nutshell is that is going to be contributing to the federal as well as the state that you live in. And these things actually pay that our society need as a whole, which is public transportation, public assistance, the schools that you are in, law enforcement, as well as the emergency personnel as well, to just keep our nation safe and also to help us in need as well.
Yeah. So all the things that you enjoy, public services, things that are provided by somebody else, are typically funded through our taxes. So you have taxes at the federal level and the state level, and that is how those entities fund all of these initiatives that they want to do. Income tax is the one we're going to be talking about today, but there are lots of different taxes out there. So we're going to focus on this income tax idea, which is what most of us are thinking about right now, because income tax filing day is coming up on April 18th. Now, what is that? What does that mean?
So basically, when we file a tax return, you are just reporting all of the income that you have earned in that tax year, and you are just reporting that information to the IRS as well as to the state that you've resided, if they also require you to file an income tax return. And this is just to ensure that the information that was provided by employers, by the businesses, by financial institutions was furbished to the IRS. And the IRS is just waiting on you to just confirm that information on that return so that everything ties together at the end.
Yeah. So we have spent the entire previous year. So we are paying, or we're filing our tax return for the fiscal year 2022. So from January 1st to December 31st. And that is a summary of all the money that you made during that time, as well as some of the deductions and expenses that we may have had along that way. So the IRS has an idea of how much you've made already, how much you've paid in taxes already, or at least that your employer has paid on your behalf. If you work for yourself, you may be paying your own quarterly taxes. But this is that reconciliation at the end of the year to be like, did you pay enough? Did you not pay enough? Did you pay too much? And let's balance things out. April 18th, tax filing day, is not the day that everyone submits their taxes. It's the deadline, right? So what is our window for doing the tax return?
So the window as into just the process of putting it together, correct? Okay. So basically what you need first thing is you need to gather in all the tax documents that you have are going to receive based on that tax year. So for example, in 2022, if you have worked for multiple employers or multiple businesses and they hire you as a W-2, you will need to make sure that you are collecting your W-2s from those employers and making sure that they are accounted for. So if you have done any freelance or contract work and you have filled out a particular tax form, which is a W-9, that indicates that you will be receiving a 1099 the following year based on the services that you have provided for that person who hired you for that service line. And another thing to also keep in mind too, is that if you have your own bank account, and primarily if you have a savings account and you are receiving some bank interest, then that also will need to be reported on your return. So just be on the lookout for that 1099 as well. And there are numerous 1099s out there. There's like the 1099 non-employee compensation form, the 1099 miscellaneous, the 1099K, which is usually provided by a third party payment processor such as Stripe or Square. And then you have the 1099 interest form from the bank institutions.
So a lot of these 1099 forms, and don't let it overwhelm you. Most of these companies are going to send these to you, or they will send you an email saying like, hey, your tax document is available. Here you go. Or here's where you can print it, or here's where you can find it. So you want to look for your employer's records, which is your W-2. So your employer should be sending this to you. They're legally obliged to send it to you. And they have to send it to you by what date?
So legally, those 1099s are supposed to, as well as the W-2s, are supposed to be handed by the end of January, usually January 31st of every year. If you do not receive it, this is a good time when you cash that on early to reach out to those employers, to those businesses, to make sure that you will be receiving those documents, because you want to make sure you are reporting that information on your return. Because if you do not report it because you did not receive one and the IRS happens to see it on their end, they are going to issue you a CP 2000 notice towards the end of the year to basically notify you that they have received a particular W-2 or 1099. And unfortunately, you did not report that on your end. So they will go ahead and make those adjustments, which could impact you. In this case, you could likely end up owing than receiving. Yeah.
Yeah. So it's a lot of this is on you. And we see a lot of memes around this time of year where it's like, oh, you owe me money. And this, I'm being the government, you owe me money. And the person asks, well, how much? I'm like, well, you have to figure that out. And like, well, how do you do that? Well, I'm not really sure. It's like, it's very much a guesswork game. But in this scenario, what we're trying to do is collect all of our documents, have them in one spot, and send our summary of what we did and what our employers told us we've done, or our own records of earnings and income to the IRS so that they can reconcile it and make sure that we have paid enough, or we've overpaid, or we've underpaid. Okay, so our tax system, we're not going to talk about how our tax system works today. Hopefully you've covered that in class, but the gist of it is that you have a graduated tax system here in the US. So it's not a flat tax system. So in most states, you have sales tax, which is a percentage that is tacked onto the cost of the item. That is a flat tax. In income tax, it's a graduated or a bracket system. Do you want to take like 10 seconds, 30 seconds, trying to explain what that is for us in a nutshell?
So basically, don't assume that the income that you are earning is taxed at a specific rate. For example, let's say you earn $50,000, right? And that falls under the supposed 22% of in the tax bracket. That does not mean that all that income is taxed at 22%. What basically happens is they break it out into, I call buckets. So usually like the first 10,275 of that 50K is 10%. And then the second bucket, which is, I believe, is between $10,000 to $40,000, that is 12%. And then the remaining of the 50,000 is at 22%. And that's how they calculate your income tax.
Yeah. So you think of it like a series of buckets. I really like that one where you're pouring into the first one. When it overflows, it starts filling up the next one and the next one, the next one. So you're going to fill up the earlier tax brackets at a lower rate and then progressively make your way up into the higher ones. The idea being that if you are a low income earner, you will keep a higher percentage of your income than if you're a high income earner. It taxes people who have more income at a higher rate than a lower income rate person would have. Okay, if you want to know more about that, you want to see a visual of what that is, On your student reflection document, I do have a video linked that I created, which visually shows how the tax bracket system works. So please check that out if you want to see more. All right, let's get into some of our questions because that's what today is all about. So if you have questions, please drop them in our chat feature and we want to get them answered for you. The first one comes from Gianna and she wants to know, when do I need to start paying taxes? So what is that point at which a teenager says, all right, I got to start paying taxes?
Ooh, that's a good one. So again, wages that you have received from your employer or any business income that you are earning, as well as any investments, if you are starting early on, when you start receiving that income, that is when you start paying taxes on it. And just know that, for taxpayers, when you start to reach this figure, which in this case in 2022 was 12,950, that is when you must file a tax return. This year it went up, so now the minimum threshold to file a tax return is 13,850. Now, if you are someone who has a business or are doing some freelance or side gig work, then you are required to file a tax return if you have a net earning of $400 or more, because you are self-employed and you are subject to two types of taxes, Social Security and Medicare taxes.
Okay, so those are collectively known as our FICA taxes. Everybody pays those. As soon as you start earning money, in this case, over $400, if you're self-employed, you're supposed to be paying FICA tax. That goes into our Social Security and Medicare plans provided by the government. But you said if we are making under 13,850 this current year from our employer, we're not required to submit a tax return, but could we still, or should we submit a tax return?
I recommend you to still file a tax return if you know or would like to know if you had any taxes withheld when you was working for that employer. And the reason is because when you filled out that W-4 when you first started your job, you enter in the information, but it could be that when you were being paid on a weekly, bi-weekly, or monthly basis, you probably had some taxes withheld either from federal or from state. And there's a possibility that when you file, they could refund you back the money depending on that income threshold. But for the most part, I have worked with teenagers where they do get all of their tax withheld returned back to them. So for example, I had one last week. He had earned, I believe it was like $7,000, and he paid in taxes, combined both federal and state. It was like $300. And they returned that full amount back to him. And I don't know about you guys, but I know that you guys get pretty excited when you see something like that being returned back to you. And he was very excited, and he was ready to actually reinvest that money back he wanted to go ahead and start a new business venture, even though it's a small amount. I'm very happy to see that he's actually wants to invest his return into something that can actually help build his financial portfolio in the future.
I'm so glad you said that, because I think for the average American, when we get a tax return, we're like, excellent, there's this windfall of cash. And guess what happens? Most people go spend it. They don't save it. They don't invest it. Like, oh, this is money I didn't really plan on having, so it's time to treat myself. And you will see advertising around this time ramping up with, hey, you got a tax return coming in, come buy a new TV. You need that new car. Let's get you into a new house. Like, all of these things are designed to pick up on the fact that people are going to have maybe a little bit extra cash around this time, and they want them to spend it. So you, as the savvy consumers that you are watching this video, have a plan. It doesn't have to be saving, it doesn't have to be investing, but you've got a plan at least of what you're going to do with this money before it comes. So think about, okay, if I got a couple $100 back, what would I do with it? Would I save it? Would I invest it? Would I put it towards a car down payment, towards college, towards career stuff, whatever it is, and then execute the plan. Don't let it change depending on the amount of money that comes in. All right. So is there a minimum age we need to be before we have to start filing taxes? Like, say we got one of these kid YouTube stars who like is opening up toys on YouTube and is making a lot of money doing that. Do they have to file a tax return even though they're like 5 years old?
So for tax purposes, there is no minimum age requirement. As soon as you start receiving that income, you are required to file a tax return because you have to pay the income taxes based on that particular income that you receive, whether again from YouTube, from your small, your side gig, from McDonald's if you're working at McDonald's, to Old Navy, we're working at retail. As soon as you start earning that money, that's subject to be taxed.
Okay. So then Gianna asked a follow-up question about what do I need to think about at tax filing time? And you've already talked about this a little bit, like we need to make sure we have our documents. So did your employer, so this is the person you were an employee for, did they send you a W-2? Or if you are a contractor, meaning you probably work maybe part-time there, you're not officially an employee, they're sending you this 1099 form to say, this is how much we paid you, but we didn't take any taxes out on your behalf. So that's a summary of how much money you made. You might get something from PayPal or Square or Apple Pay as well if you've been receiving money or sending money that way. If you've been investing, so maybe you've been listening to your teacher talking about investing and you started buying or selling stocks, anytime that you sell a stock, you're going to potentially have tax to pay on it if you made a gain in particular. Cryptocurrency is something that the government is starting to look out for. So if you've bought or sold cryptocurrency, you're going to have to let them know about that. Is there anything else we need to think about that we should have ready before we submit our taxes?
Oh, yes. For a lot of folks who are taking on 1099 work, I definitely recommend that you keep track of not only your income, but also the expenses relating to that line of work that you have done. Meaning that if you had to utilize your phone to be in touch with the person that hired you for your services, a portion of your phone can be written off. If you are a driver, you are a student driver, driving to that location, your gas and your mileage can also be a tax deduction as well, because you had to bring yourself to that place where you have to conduct and do work. Another thing that I also recommend too is if you had to purchase yourself some lunch while you're doing that 1099 gig or work line, your meals can also be a tax write-off. So I definitely would recommend that you just keep track of any activity that you have done for that line of work. And once you have that in a spreadsheet or in a notebook, work with a professional to see, if they are able to write off all of those expenses, to just ensure that you're maximizing your tax deductions. Because when you are at 1099, again, as I mentioned, you are responsible for paying the self-employment taxes, not the income tax. The self-employment tax is what really hit hard for many taxpayers. So it is vital that you utilize those tax write-offs to your advantage to help reduce that self-employment tax. Because when you reduce when you reduce your so-called profit, you're reducing that self-employment, so that you can pay as low as you can when you file in your tax return.
And this brings up a huge point that businesses and individuals are separate entities sometimes in the tax law. So you have you as the person, then you have your business. Even if like you haven't turned it into an LLC or anything like that, you just starting your own business or doing some gig work. So this is where you're doing work where you get paid per job that you do. So maybe being like a dog walker or a delivery driver or writing articles for an online blog or paper, things like that. That is gig work where you're just getting paid for it. There's no taxes being taken out and you have to keep track of all this yourself. So your business will be taxed on its profits. So you have the money that comes in, which is your earnings, subtract your cost, you're left with your profit. That's what you're going to be paying taxes on. So as Sonia said, like keep track of all these expenses throughout the year, because they're going to reduce the profit of your business, which on paper means you're going to pay less in taxes. So I love that you said that. Keep track of your earnings, keep track of your expenses throughout the year. And this is just a great personal finance tip in general. Like you guys should be keeping an eye on what am I spending? Where's my money coming from? And then just either put in a spreadsheet or a notebook. Like you said, I like spreadsheets. It's very clean. It's very easy to read. And then at the end of the year, you've got this summary. And then you can see, does my W-2, does my 1099, does that match up with what I thought I earned? because I know this year I had my own records and one of my 1099s came in and it was wrong. They told me they had paid me an extra $3,000 compared to what I should have been paid. And I had to write back to them and be like, hey, my records say no.
Oh, I've seen this a lot of folks, which is why I recommend many taxpayers to keep track on a monthly basis, your revenue and your expenses, especially because we want to make sure that that number ties back to what supposedly should be on that 1099. And when we catch that error early on, we can go back to the person who issued that 1099 and have them correct it so that, again, you can avoid paying more in taxes. And also, when they make that correction, that will be sent along to the IRS, and then you can be at peace knowing that you have the correct information. So that way you won't get a so-called nasty letter or a nasty notice from the IRS towards the end of the year. And I also want to mention too, that when you have the list of your income and your expenses, take the opportunity to just categorize your expenses. It's going to be so much easier for us tax professionals to enter that info onto the Schedule C, because that particular tax form is what we're going to enter in your income and your list of your expenses. And it's just going to be easier on us to know, like, hey, this is your revenue. Here are your breakdowns of the expenses that we're going to let the IRS know, as well as state. And then on bottom total should calculate what your net profit would be as well. So it's very vital to have that. It'll be easier on both parties.
And this actually brings up Amelia's question about, when do I engage the services of a professional? Because I know in our personal finance class, we go through TurboTax simulations to show, like, here's how you can file your own taxes. So you can DIY this, you can do it yourself. At what point do we say it's time to bring in some additional help? So the free software is not enough anymore. Now we want to engage the services of a tax professional.
I definitely would recommend that if you are seeing a net profit in your business primarily, then this is where you would need to talk to a professional to have you work or come up with some tax strategies to help reduce that self-employment tax, or try to come up with a game plan where you are going to be making those quarterly payments based on those profits in a timely manner, so that you're not caught off guard the following year when you file your tax return. Because a lot of people get shocked when they see that bill and they tell themselves, like, how did this happen? Why am I slapped with this huge bill? And that's because they didn't incorporate tax planning, tax strategies to avoid that mess. So when you do see a growth in your business, in this case, that's when you need to work with a professional to help come up with strategies so that you guys have a game plan and you guys are fulfilling that plan to towards the end of the year, so that you guys are on track. I also do want to recommend too that if you are starting, investment, and you start seeing some capital gains in your investments, or even losses too, I think you should also work with a professional to help you with that, so they can guide you and prepare you for any other additional taxes that may be coming your way based on those capital gains, or in these losses, if they're able to help you in your tax situation.
And you may be listening to that being like, I'm not quite sure what she's talking about here. And that's totally fine. This is one of the reasons why we bring in a tax professional, because what you are going to be paying for is somebody else to be an expert on all of this stuff, so you don't have to be yourself. If your tax return is very simple, like you have one part-time job and your employer sends you a W-2 or you get a 1099 and like, that's it, this is me. You might feel very comfortable trying to do this on your own and using a service like TurboTax to fill out your tax return. And that's great. If you can do that, that's awesome. It's going to save you quite a bit of money to be able to do this on your own. But as things get more complicated, so you introduce a partner, so a life partner, so get married, something like that, kids come into the picture, you start having side income or your own business. Like for my wife and I, like we have, I think maybe 8 or 9 different streams of income that have to be accounted for at tax time, and trying to do all that myself seems very overwhelming. So even as like a financial educator and someone who knows relatively how to do a basic tax return, like I'm still hiring somebody else to do this because I don't want to make the mistake. And or my tax professional knows the different expenses that I can write off, the different deductions that I can have, the different tax credits that are out there that maybe I just wouldn't be aware of myself. Follow-up question, how much is an accountant to hire?
Ooh.
And I know it depends on where you are, but like, can you give us some sort of ballpark? Like if we were going to go hire an accountant, what should we expect to pay?
Yes. Okay. So it depends. For on my end, a simple return starts at 275. That's not including the business or investments activities. Now, more advanced starts at $650. But again, every state varies. So it doesn't hurt to shop around. But just keep in mind that when you are shopping around, to just get a really good feeling of that professional, just to make sure that they are in the best interest for you, because you don't want to just hire anybody just because they are on a cheaper alternative side. It could be that they might not be well experienced or well informed with the tax laws, or heck, they may not be in full compliance. And you don't want to hire somebody who isn't willing to be in compliance with the law, because that could not only put you at risk, but it can probably hurt you financially down the run. So that's kind of my take on, why you should hire a professional, and consider investing in one, because they will help you out a lot.
Yeah, and it does sound like a lot of money. And I felt the same way when I first saw how much a CPA was going to charge us for a tax return. But you do very quickly, as you get into adult level salaries and your business starts growing, you're like, okay, like I can see this as a valuable service that I am hiring for. And in a lot of cases, the accountant that we hired found more deductions and credits and things that we could claim as reduced profit in our businesses, that it started paying for itself a little bit. Like if we'd done it on our own, we probably would have ended up paying maybe $800 more. And by paying our tax professional $800, it sort of levels out. So you end up paying less overall, or you at least get more money back, hopefully from your return. But I love your advice. Shop around. Just like most times when we hire a professional, compare at least 3 different people. So go meet with them, see if you like them. Do they have a teacher mentality at their core, or are they kind of just saying like, yeah, send me your stuff, I'll take care of it. And they're not bothering to educate you on what's going on or how it works. Those are sort of red flags you want to watch out for. Find somebody who's willing to take the time and explain to you what's going on, and we'll sit down and build your strategy with you. Like they're not just saying, send me your stuff and I'll see you next April. They're saying like, okay, let's talk about next year and how we're going to reduce your expenses, or what we're going to track, or what you should be keeping an eye on, or try this out, stuff like that. They should be on your team. That's why I was like, your tax professionals on your team. They're not just somebody you hire off the street.
Yes. And I want to also add to that, I know for a lot of folks, they do see as us tax professionals, someone just plugging in numbers. I mean, yes, it's true. We do plug in numbers, but at least for me, I try to my very best to educate and try to simplify what's on your tax return, so that you are able to understand and feel more confident knowing that your numbers are pretty accurate, because ultimately you're signing the return off at the end of the day. So God forbid something happens, right? The IRS is going after you. They're not going after the tax profession. They're going after you because they are seeing you as responsible for accepting the terms that's on the return. Yes, you can go ahead and throw your tax profession under the bus, but IRS in the state is going after you. End of question. And it's a sad reality.
Yep, you will sign a document. Even if someone is preparing your tax return on your behalf, it literally says, this is being prepared on your behalf. You are saying that this is good to go, and you are technically sending it to the IRS. So your professional is just kind of helping you out on the side. They're not liable for the mistakes or lack of information or things like that. So you have to be careful with who you hire. Find out what they specialize in. So do they specialize in people with small businesses? Do they do personal tax returns? Are they doing big multi-million-dollar tax returns for big corporations? Find someone who fits your style of tax, and then look for someone who's in your price range as well. Like do look for that, but try and make sure that that's not the number one thing driving your choice. Okay, moving on to the next question. I like this one. Do I need to pay taxes on tips or money paid to me as cash? And this comes from Miss Cran's class.
Ooh, okay. So any cash and tips that you receive is subject to income tax, Social Security, and Medicare tax, no matter what. By law, too, you are supposed to report that on your return. Now, if you are receiving tips, you should be hopefully be reporting that amount that you have earned to your employer on a monthly basis. And I believe that the deadline to report your tips is usually the 10th of every month. And that requires you to fill out a particular tax form. Also, I know that some employers do have a log system that they utilize to have their employees enter in the tips amount that they have earned in that day, that week, that month. And if you are receiving more than $20, I believe that's the minimum, you should be reporting that. So yes, any cash-based tips as well must be reported and recorded on the return.
And I know that like we can't give illegal advice here. And this is one of the ones that followed up on this. I'm like, this is just a straight up teen question right now. How is the IRS going to know if I don't tell them about my cash?
Very good question.
Is it one of these things that if I don't report it, there's a very low chance that anyone's ever going to know? Is this just like me being a good citizen and saying like, yeah, I made some cash and there's really no chance anyone's going to know about this? Or is there the potential that, this will bite us at some point in the future if we are earning cash and we are not reporting it?
So when it comes to that particular situation, the IRS kind of relies on the honor code. So it's really up to you if you want to report that cash or not. But here's the thing though. If you are looking to grow your financial portfolio in the future, right? If you want to buy a home, you want to get business funding or qualify for a loan, let's say, you by reporting that cash income early on your tax return will create and will build you history, because lenders are going to see like, okay, we're seeing that he or she is having income and we're seeing growth year over year over year. So we feel more confident with this taxpayer with lending our money, because we can see that he or she is going to pay it back plus interest. So this, as soon as you start receiving payments in cash, I just would suggest that you start keeping track of it so that you can start building history when it comes to filing your tax returns, because this could be beneficial for you in the future, especially if you as you get older, you're going to start having, you're going to start having more jobs, you're going to have a pay increase, you're going to have a family, and obviously you want to have your own home. If you want to start a new business venture, you want to make sure you have everything recorded on that return, because they will look at that. Yes, they do a look at other financial statements, but they really do focus on that tax return to make a determination whether or not you are a good a good person that they can lend money to.
Yeah. So your tax return is the official statement of how much money you have made, paid in taxes. And particularly those of you who are going to college, your FAFSA form will look at your parents and you, so your legal guardians and you, in terms of your last 2 years of tax returns, and they use that to calculate how much federal aid you would qualify for. So it is something that can potentially help you or reduce the amount of aid that you get, but important that we are kind of thinking about that. Okay, if I want to borrow money in the future for things like a house or a car, that showing that I have income means that I'm showing I have the ability to repay this loan. And that's something that might help you in the future. So definitely something to think about that I hadn't thought of before. Bailey asked a great follow-up question to this. He's like, well, what if you get paid under the table? And, in quotation marks, that means that there's no official payment happening right now. A business is handing you money and they're saying this didn't happen and we're not going to record this. We're not going to report this to the IRS. Can you get the person paying you in trouble if you report this income and saying that they paid you and then they didn't actually say that they did it?
So typically in this case, what I advise is that we're going to treat that under the table income as they were paying you as a contractor, which we would then fill out a Schedule C. But before we even begin that process of filing that particular tax form, we need to look back of how much cash that you've received. And if you have a bank account and you were putting in cash deposit, I usually start with bank statements. Let's review that particular tax year, review those cash deposit, and then confirm whether or not that cash deposit was indeed from the job that you have the job earned that the income that you have earned from that job. And then we will then determine, okay, based on that income, was there like any expenses that we can utilize so that you're not hit with a big bill? That's kind of like the starting point that I usually go with for those who are, again, on a cash-based basis. Start with the bank statement and then try to determine, okay, what expenses might be helpful to help reduce this bill. We also start creating like a log ourselves too, in case of a potential review or audit down the line. We have the backup data ready on deck in case they need to look into it. Again, you're not going to get the person who hired you in trouble. No, because if anything, I think the person who's paying you in cash is probably losing out because they're not writing that off on their tax returns. So I think if anything, they're probably, paying the full amount. But again, everyone's situation is different. But this particular case, we do go on a case-by-case basis. So, but yeah, for the most part, like if you want to go ahead and start reporting your cash payments, don't be afraid to report it. You're not going to get your employer in trouble. In fact, you are, again, you're being a good scout by honoring the system, by reporting that information. The IRS just wants to know what you have earned and if you're going to pay your taxes, and that's it. That's the end of the day. They're getting their cut. They'll be satisfied with that.
And we have a couple of questions about tips. Taylor wants to know if tips are divided weekly and given out, do you have to report them? So if your employer takes all the tips that are gathered on a weekly basis and then says, okay, we're going to divide this evenly amongst the staff. So it's not, if you're a server in a restaurant, like it's not what was left on your check that goes directly to you. You're getting like a slice of it. Are you reporting how much was written on your check? Are you reporting on how much was given to you by your employer? Or how do we report that back? Or is our employer just kind of keeping track of this because they're the ones paying us?
I mean, technically by law, employers are supposed to let the employees know that they should be responsible for keeping track of that tips. But I do know that some employees do rely on the employers. But this is where you got to keep a track of your own cash that you're receiving, those tips, because you want to make sure that they make sense. It could be like Rob had experienced that they say they overstated an amount and that wasn't true. You have something else showing differently. So I think like it's good to just make sure that you're both in alignment with that amount. But when it comes to distributing the tips evenly, whatever they gave you is what you should be recording, not the full pie that they got. If they gave you $20, that's what they're giving you. If they received $200, but they only gave you $20, that's what you're going to record and on your log. And if they don't record it on their end, but at least now I know that you have a record of that and you can go back and prove to them, like, this is what I had on that specific date. So make sure you have the dates, the amount that you received. And I believe like if there is an event, make sure to note an event under the description box as well, because sometimes they tend to forget. And I've seen that several times with folks.
And yeah, this comes down to that categorizing your expenses as well as your income. Like you can go back to your bank statement at the end of the year and be like, hey, every time I got cash, I put into my bank account. So I should be able to find that. It's really hard when you look at the amount of transactions you make over an entire calendar year, particularly. I think once you become, full-time adult mode and you're paying for all of your expenses, there's a lot of transactions that happen in a given year, and trying to figure out which ones are which in hindsight is pretty challenging to do. But Ms. Cran's class, I think, has got something going on there that we need to talk about. But they also asked if I don't track my cash payments or tips for years, just say like I got a lot of cash last year, didn't track it. I have no idea really how much I made, but I know I made some. What should I do at tax time?
Again, if you are putting these cash in your bank account, I usually would like to look at the bank statements just to see how much you have put in. And we'll obviously discuss like what happened. If you happen to, again, like you're supposed to report your tips, right? And if you don't and you decide to report it at the end of the year, just be aware you're going to be penalized because you didn't report it in a timely manner. And that was supposed to be paid or supposed to be reported on a monthly basis, because the thing is that the IRS needs to factor in the Social Security and the Medicare taxes based on those tips. So you don't want to give them any more money because you failed to report it on time. Try your very best to build yourself that system, that habit of recording things. But yeah, I mean, for the most part, I think, again, I usually like to go back to like square one, like, okay, you didn't record anything. Let's just look at your statements. We'll just run it together and then see, what those deposits were. And then we'll just create a log in case, again, they ask for it in the future. We have it in there. And then we'll make sure that we are reporting that the amount of tips that you have earned based on this particular form. The form number is escaping me, but that's where we will just let them know, like, hey, this is the amount of tips he or she have received. She is or he is aware he has to pay the penalties and interest for failing to report it on time, but we will like to move it forward. We'll make sure to keep track on that. So because, Social Security and Medicare, that might be very, you might be utilizing that as you get much, much older. So we want to start making sure we're getting you those credits that you need now as early as possible, if anything.
Yeah, that's really good advice there. So yeah, it's going to be working with your tax professional. It's going to be doing the best you can. And then make sure moving forward that you are doing a better job of keeping track of this stuff and reporting tips on a monthly basis. I did not know you're supposed to do that. So that's something I just learned today. Okay, moving on to the next question. A couple of questions about being a dependent. So a dependent is someone who basically is not fully responsible for all their own expenses. There's somebody else who is helping to fund their life, and they are claiming you as a dependent on their income. So if your parent is claiming you as a dependent on their income, do you still need to file a tax return, or are they kind of taking care of all of it?
So if your parents are claiming you as a dependent, yes, you can still file your own tax return. When you're filing your own return through TurboTax or with a professional, just make sure that you are checking off, or the professional is checking off the specific box section that's on the return that says someone will claim me as a dependent. The reason it's very important that you select that, because we want to avoid a rejected return on the parent side. Because let's say you beat them to the punch and you file first and you fail to check off the dependent section, your parents or whoever's going to claim you as a dependent on their return, if they file that return and submit it and they get a rejected return, that's because you had misfiled your status on the return, which is preventing them to claim you on their return. And that is going to require the professional or even the taxpayer to amend that return, which is a headache. And I have seen this a lot. So please communicate with your folks who are going to claim it as a dependent to make sure that you are, or with the professional too, letting them know someone's going to claim me as a dependent. I just want to make sure that, they have yet to file, but I'm going to file because I have my paper documents ready. Just make sure you have that so we can avoid that mess, because I've seen this a couple times with folks where parents and the kids, they're not communicating with each other and they had no idea, and that just leads to another headache and a mess. But this stuff is fixable. I will say that it is fixable. It's just a nuisance to go through. But I want to say, yes, you can go ahead and file your own return. Just make sure you're checking off that box. And I know that folks do tend to ask, like, oh, well, will this also, the income, will that also affect my parents as well, or whoever's claiming me? And the answer is, it depends. Okay. So let's say the parents, right? They want to include their teenager's income on their return. What I usually tell folks is that we can do it that way, but keep in mind that when we're including the child's income or the teenager's income, it's going to increase their taxable income, which is going to result in a higher income tax and a reduction of their tax credits. So this is where I recommend parents or anyone who's going to be filing dependents, and they have dependents who have their own income, to have the dependents file their own returns, so again they can avoid those increases on their end. And also the teen can get back their money if they are eligible for a refund based on their tax withholdings.
Okay, so your parent could technically just claim your income, pay their level of tax. So they're going to be probably at a much higher tax rate than you. and everyone's squared away that way. The IRS is happy. Or you file your own returns and the younger person is filing as a dependent on their parents' income or whoever is claiming them. Does it impact the amount of tax you get back if you are a dependent versus not? Like, does it actually change anything about like the standard deduction or the brackets or the percentages?
Yes. So if you claim yourself as a dependent, you have a lower standard deduction because typically, if you are filing as single, the standard deduction is, in this case, right now for 2022, is 12,950. That increased though this year. That's your standard deduction. But as a dependent, I believe I could be wrong. I don't have the figure in mind, but I believe it's like $4,000. It's a big difference in standard deduction. But it's a case by case. I do see that, if you have earned a significant amount and you are able to prove that you are able to live off of that income, then we could decide having you file as single. But again, it's a case by case. Usually for the most part, dependents usually don't over exceed the standard deduction of 12,950. They typically earn less than that. And when that happens, we see that the taxes that they had paid, they get refunded back for that particular amount that they had on their W-2s.
Okay, and just in case you're not familiar with the term, a standard deduction is the amount of money you are allowed to earn without paying any taxes on it. So it's usually just cut off the top of your income after Social Security and Medicare have been paid, but after that comes off of your income and then we tax the rest. That's called your taxable income. There are other things that can reduce the amount of taxable income you have, but just at its basic level, a standard deduction is the money you can earn without paying taxes on it. So if you are filing single, that means you are an independent financial person. Your standard deduction is higher. If you are a dependent, so you are living off of your parents' income as well, or they're funding part of your life, or at least on paper they're doing it, your standard deduction is a little bit lower because you're not expected to spend as much money on yourself. You're not covering all of your own expenses. So yes, being independent will lower your standard deduction. So good information for us to know. Okay. Miss Lean Kuehler's class wanted to know, how can I legally avoid paying taxes? So I don't like this tax thing. I want to keep my money. How do I avoid this thing legally, of course?
Okay, the legal way. This is a very common question that I get on a daily basis. So for teenagers, we definitely we will have to see like what kind of deductions you may be eligible for to lower that taxable income. And usually that typically happens if we see some losses. So let's say you had investments and you sold off those securities or those stocks or ETFs. We can utilize those losses as a deduction to reduce that taxable income. Another way too is that, hey, let's say your business is doing really well, and you made a net profit. You can qualify what's called a qualified business income, or QBI. I believe that's the correct term, QBI, and that's basically a percentage of your net profit that you have earned. Usually it's up to 20%. So they give you a tax break for making a net profit on your business, believe it or not. So, and a lot of people tend to assume like, oh, if I made a profit in my business, I got to pay more taxes. Like, yes, you get slapped with the self-employment taxes. However, they also give you a tax break for making profit. So don't be afraid to make some money. Up to 20%, that's not a bad deal. Another way too is consider contributing to a retirement account, especially like a traditional IRA or 401, just because that's also another tax break that's also going to reduce your taxable income. I know that obviously teenagers, you guys can't really max that out, but try to put something towards it, because not only are you going to get a small tax break, but you're also going to start building your retirement fund so that you can live off of it in the future as well. So those are like one of the two things that I usually advise teenagers to just, when it comes to like avoiding or reducing their taxes. For now, you guys do not qualify for any credits at the moment, but as you could progress in your life and you start, if you start having a family, then you could be eligible for like your children tax, the child tax credit there, or even the earned income credit. That is when you start filing as an independent single filer. So you will be entitled to those credits down the line. But right now, what you got to work with is those deductions in your favor, and work with a professional to help you come up with ways to see where else you can qualify for in terms of the deductions, to just avoid a tax bill surprise when you file tax returns, and also try to strategize well so that you guys are again, avoid being in the same cycle. If you're in a messy situation right now, it's better to just plan accordingly, and yeah.
Okay, so the big one for most of you guys is going to be the retirement account. If your employer offers you one, particularly in the coming years, if you're leaving high school and you're starting to work full time for someone, if they offer you a retirement plan through your job, you can invest in that either usually through a traditional contribution or a Roth one. Traditional means that your money is going in before tax. So it's going to reduce the amount of money you made, so your taxable income for that year. And when you eventually take the money out on the other side, so you've retired, you're taking the money out, you will pay taxes on it then. So it's a way of reducing your tax now, but you will pay it later, most likely. Roth, on the other hand, you say, nope, tax my income now, and then I will take it and I'll put it into the IRA like you would a savings account or checking account, like you're putting after tax money in. It grows, grows, grows. And when you take it out, there's no more taxes owed on it. So look at how much money you're making. Am I owing any taxes currently? Am I only making a couple of grand a year? If so, a Roth might be a better option for you, because then you're paying no taxes now, you're putting your money in, and that will grow and be tax-free forever, essentially. But if you're making more, consider the traditional option. Contributing to a 529 plan is another way of potentially reducing your taxable income, at least at the state level. So look at, this is one of the things you might ask an accountant about. So if you are working with an accountant or your parents have one, you could just ask them these questions. And that'll be nothing. Don't be afraid to send your accountant an email during the year and be like, hey, I have this question about reducing my taxable income. Would putting money into a college account help me right now or not? And they can maybe potentially answer that for you. Your team members should answer that for you. All right. We're almost at the end of this. I want to clarify two terms that you said, that just in case we don't know what they are, let's get clear on them. An audit and a review. So you said the IRS might audit you. What does that mean when the IRS audits you?
So when the IRS sends out a notice that they're going to audit you, that means is that they need to verify the information that you have provided is correct, because what they see is inconsistency and a few errors that they need clarification on. They will ask for a lot of documents supporting those deductions or those credits that you are trying to claim on your return. And I also want to make sure too that the info that you also provided, such as primarily like the business income, they need to make sure that your financial statements, your balance sheets, your profit and loss, they tie back to this return. If they see a difference, that's not good. And what they're going to do is they're going to determine what they think should be on that return by making those adjustments. And that's going to cost you, because now with them taking control of the return that you are responsible for, they're going to do what they think should be on that return and will give you a bill based on what they have seen, what they determine what's on that return. A review is just basically just to make sure that certain areas that you have reported make sense. It's not an audit. It's just like, we just need some supporting documents to ensure that you are entitled to those deductions or those credits, or we are missing an information that we did not receive, but you happen to have it. Could you just send that over to just review and confirm that what you have entered is correct? And then we'll make a note on our system. And that's pretty much it. It's just a simple, like, here you go, here's my documents. They'll take it and record it on their end. An audit, they sit down with you and they go through those financial statements and any other documents that you have, and they do it on the spot, those adjustments. And I prefer review over an audit because the review, they kind of trust you. They're just kind of like, just send those over. An audit, they literally sit and go through everything with you. And that's not a good experience.
No, it's one of those things we want to try and avoid, and doing your due diligence in terms of keeping your own records and submitting an honest tax return. So declaring the money that's coming in, so particularly businesses, like you have to declare your income. You can't knock it down and be like, oh yeah, I only made a couple $100 when in reality you made a couple $1,000. That's when you will get badly burned if you get audited. And the penalties, from what I know, are quite big. The other words you threw out that I just want to clarify on were deduction versus credit.
Okay, yes. So a deduction, how I see, is a tax break, and it's reduces your taxable income. So, and in order to determine your taxable income, they need to know what deductions or what tax break you qualify for before we start to determine what your income tax is for that taxable income. Now, a tax credit is what it does is it's a dollar for dollar reduction of your income tax as well as your self-employment tax. And that's like after factoring in your taxable income. And tax credits are really helpful. They tend to help a lot more. So in this case, there's a lot more credits than deductions, believe it or not. And what happens is too that depending on the credit, there is a difference. There's the non-refundable and the refundable. A non-refundable is basically they'll give you a credit, but if you have leftovers, they're not refunding you back that difference. Unlike a refundable credit, meaning like they were able to shave off that income tax bill or that self-employment and you have leftover, they'll refund you back that leftover. That's what a credit is. Hopefully I made that clear.
Yeah. So deduction will reduce your taxable income. So it comes off at the top and then you still pay your taxes afterwards. A credit comes off at the bottom. So after you figured out what your tax bill would be, then it starts knocking off of that. So credits are usually more valuable than deductions. Okay. So the final question that I ask all my guests is, what is the number one piece of advice you would give to teens about building wealth? And you can make it tax specific, or you can talk about wealth building in general.
Oh, so I would say utilize the tax return to your advantage, because that's going to help you in the long run, because showing that amount that you have earned year over year will qualify you for business funding, a mortgage. So that way you can start building and expanding your financial portfolio. So it doesn't hurt to start filing your return now, because it's going to help you so much as you progress in your life, and you're going to have a better financial future as well.
Right. Sonia, thank you so much for your time today. Where can people find you?
Oh, yes. So I am on Instagram, and I also started TikTok as well at Castelan Tax Services. You can find all of my videos there. I have a lot of tips relating to small business, freelance, side gigs, as well as for personal taxes as well. So feel free to tune into that. You can also shoot me an email as well. Be more than happy to answer any other questions or concerns you have, as well as my DMs too. I'm pretty, I try to get back to many people as much as I can. So feel free to reach out. And I also have a free tax prep checklist as well. So I will be more than happy to provide that link to Rob so he can issue that out to you guys, so you guys can utilize that to be prepared for your first filing tax season.
You can look for that in the YouTube description on the replay if you're watching it, or I will try and add it into the student reflection document. All right, Sonia, thank you so much for being here today. We really appreciate your time. And we covered a lot of questions today around income taxes. If you still have questions that have not been answered, so the top of your sheet had a question, didn't get answered today, please put it in the YouTube comment section, and we will try and get in there and answer those for you. Either myself or Sonia can come in and answer them. But appreciate your time today. Thank you so much, and we'll see you again soon.
Thank you so much, Rob. Thank you again, you guys. Take care.
Bye.